Hey, this is Justin, and in this video we're going to talk about 3 distinct profit-taking strategies that you can use. I'm going to save this 4th one for a separate video. I've just decided keep that separate. But in a quick side note here before we get going, in these profit-taking strategies, I am using the idea of our relative aggression bars. We have relative aggression bars as part of our software as kind of the basis behind these. And by all means, I highly recommend you do become a member and use the software. I think you'll love it. I would never trade without it at this point. Obviously, I'm biased, but I love it. People, have hundreds of people that love it, and I think that you'll find that it's very valuable and you'll get more than a great return on your investment for using them. So, with that said, the strategies I'm going to talk about use that, but you can use whatever evidence you're using. If you don't want to use our bars for some reason, whatever evidence you're using, the same ideas would apply to these 3 different ideas. I think you'll see that while our software certainly makes it easy to use, you can apply this with whatever evidence you're using. I think just take the bigger picture points if you're not going to use our software and put them into practice, and I think it will have a very good effect on your trading. So hopefully that makes sense. If you have any questions about that, let me know. I just don't want it sound like this is a sales webinar. Certainly I would love you to use our software, and I think you'd benefit, but you can still apply these no matter what strategies or software you're using. So let's get going here. The first one is what we call the scale and trail strategy. So this is for people that are more on we talked about in the prior video, we talked about the people that prefer more certainty versus those that can deal with more variance. And, so again, this is for people that I don't think this is the ideal way of managing trades. I want to say that up front. But I think for maybe beginners or people that are having a really hard time managing their emotions, this is a good place to start. And the way that you'll do this, and there's a lot of different ways you can do this, but use multiple contracts. So let's just say you're using 2 contracts, whatever the case may be. You're going to take off half pretty quickly. So then you're going to move your stop up and lock in at least a break-even trade. And then you're going to trail the remaining half of the position. So you're still giving yourself the opportunity to have a big trade, but you're not making it such an emotional endeavor. You're locking in a break even right away, so you can kind of take a breath and take it easy on the trade, and then let the evidence determine for you when you should get out of that final position. And again, this is not the ideal strategy, but if you're having a lot of trouble managing your emotions on the exit side of the coin, I would recommend a strategy similar to this to kind of get you moving beyond that. Now here is an example. So let's just say that you are getting long here at 1978. And this is an example from the ES from a little while back. It's kind of a generic example. It doesn't really matter. But let's say that you got long here, and your original stop, you got long at 78, or excuse me, at 78. You're going to get your protective stop at 76.50, so 6 ticks lower. Here's your protective stop. Okay, you're going to take off half of your position at a pretty reasonable early point. So let's just say it's at 1 point there. Then you're going to move your stop to 1 point below your entry right there. Okay, so in other words, your stop then becomes this line right here. So worst case, you've got a 1 contract profit of 4 ticks, and you've got a 1 contract loss of 4 ticks for a break-even trade. Okay, at that point, as you get aggression bars that come in, simply move your stop a few ticks below that. So when this buying aggression comes in, move your stop, let's say in the ES, 2 ticks below that. So right here. Then you hold on. The next one comes in, move your stop 2 ticks below that. Because as long as these buying aggression bars are holding, you want to stay in the trade. If they start to fail, well, that's your first evidence that maybe you want to get out of the trade. So again, scale and trail. You're locking in a profit very quickly on half of your position, moving your stop to break even, and then you're just trailing the paint bars as they come. Okay, whether there's a buying paint bar or a selling paint bar. Again, these are aggression bars. I think they'd be very helpful for anyone's trading, but whatever strategy you may be using, use some kind of evidence to let you know that, okay, the reason I got in is there's at least some doubt as to why I got in based on the evidence that you use. Okay, so the next strategy then is what we call a contextual target strategy. Okay, and so the key word here is context, market context. That's something we teach all the time. And again, I think you'll find it very helpful to learn that idea of telling the market story first each day. And that's going to help you, number one, get into the right types of trades. And number two, what we're talking about here, exit the trade at the right spot. And this is for people that really don't like to use trailing stops. They don't like giving up some of their profit. They'd like to just lock in a target. And that's a good way to trade. I actually think that makes a lot of sense. The key here is you're using context to increase your expectancy. Okay, your EV. You're adding market context to the picture. So let's think about it in terms of this. Let's think about it in terms of this diagram here, where we're looking at the market context from neutral all the way to extremely bullish and all the way to extremely bearish, and then everywhere in between. Okay, so when you learn to put the market in context, you can kind of think of any given moment in time as if we're using this little diagram right here. So with that as a background, let's just say that we are getting long. Okay, and when we're getting long, we're extremely bullish. Okay, so in other words, we're pointing right here. The market's extremely bullish and we're getting long. What we would want to do in that case is take a target that's at least 3 times our risk. So if we're risking 2 points, we want to lock in at least 6 points. Maybe you go for more. But I'm saying at least 3 times the target. So you're not, in other words, you're saying this is an extremely bullish time of the market. We're in a vertical condition. We'll talk when we can talk about a lot about what that means. We're in the vertical condition. I want to be long, and I want to give the market every possible opportunity to give me as much profit as I can. I want to put my target at least 3 times greater than my risk. Okay, so that would be if you're doing it if the scale is pointing that way to the extremely bullish. Now let's say that we are getting long and our scale is bullish. So we definitely want to be on the long side. It's not an amazing opportunity, but we definitely want to be on the long side. In this case, you also want to give yourself an opportunity to make some money. So you're going to want your target to at least be 2 times what your stop is, or 2 times your risk, maybe up to 3 times your risk. So again, you're locking in a profit. You're not giving away profit on trailing it. You're locking in a profit, but you're using the market context to know that you need to go for, you've got a really nice opportunity. This is kind of letting you know you have a 2-to-1, 3-to-1 reward to risk ratio. You need to go for that. Okay, it's not quite as good as the extremely bullish, but you've got a nice opportunity here. You want to use the context to help you lock in what the right target is. Now let's also say we're getting long, but our market is neutral or even bearish. The first thing I would say is, hey, are you really sure you want to get long? But let's say, okay, yeah, I do want to get long. In this case, you're probably looking at a 1-to-1 reward to risk ratio. So if you get in with the 2-point risk, your target's 2-point risk. You're not trying to take more out of the market than is there. This is a neutral or slightly non-ideal time to be getting long. And you know that because you can read market context. And so you want to, instead of trying to hit a home run at every trade, you want to just say that there's not a lot here. There's not a lot of opportunity here. I'm going to lock in a nice profit. I hope that makes sense. The key here, again, is context. We just preach this all the time. Context, context, context. And what that's doing is that's helping you determine when is the right time to go for a big winner. When's the right time to set your target a little bit lower, to set your sights a little bit lower. If every trade you're treating as the same and you're always locking in a quick profit, or you're always going for a home run trade, you're not getting the most out of your trading that you could be getting. If you can learn to read context, and again, we talk about that all the time in our training and our live sessions and all those sort of things. If you can learn to read context, you're giving yourself so much greater room for opportunity, and you don't have to second guess yourself as much. You say, well, I think the opportunity is really great. I'm going for a big one this time. Or the opportunity is not as great. I'm just going to lock in something pretty quickly. Again, I hope that makes sense. It's such a key point. I really feel like this is an ideal way to think about your exit strategy. Let me just use the same chart that I just showed as an example. Let's say we get long here at 1978. We have a 6-tick stop. Okay. If we are, like we talked about before, if we're more in the neutral category, so we're more right here, we're neutral, but we still want to get long, then what we would be looking to do is something of a 1-to-1 risk-reward ratio. So if our entry is right here and it's a 6-tick risk, we're just going to lock in a 6-tick target. Okay, simple, in and out, done. Okay. Now, let's say that we are more in the bullish category. We like being long. We're looking for something of a 2-to-1 or 3-to-1 reward to risk ratio. And if that's the case in this example, again, we got long here at 78. We've got a 6-tick stop, 6-tick risk. We're going to go for, let's say, 12 ticks, 2 times that. So here is our target. Okay, we're in, we're out, done. But we're at least using the market context to help us make sense of this. I realize this is a generic chart. I'm just trying to give you the idea behind it, okay? Now, let's say that we are extremely bullish, and I'll show another example shortly here where I extend this chart. But let's say we're extremely bullish, then we're going for at least a 3-to-1 reward to risk ratio. And if we go back to our example here, our risk is, again, 6 ticks from our entry, so we're looking for at least 18 ticks, which would be up here. Okay, now I know I haven't let the chart fully extend, but that's the idea behind this. We're giving the market more room because we feel there's more market opportunity. Okay. Now, finally, I want to talk about more of a hybrid approach. This is really my favorite strategy. It's pretty much what I use all of the time. What I call it the contextual hold strategy. So in other words, what's the key word here? Context. We're using market context to determine how long or how aggressive we're going to be on how we want to hold, okay? How long we want to hold based on context. We're not putting a target into place. We're letting the market tell us when to get out, but we're using context to determine how aggressive or how conservative we want to be with that evidence. Stay with me. This might not make sense, and if it doesn't after I'm done, I would say watch it again and then ask questions, because I think this is I found this to be a very powerful way of holding on to trades and trying to maximize your opportunity in a trade. So again, the idea here is we got in. We're talking about in this example here that I'm going to talk. Let's just assume we're long. Okay, we bought. Why do we get in? Well, we got in because of bullish evidence. Okay, so therefore, like I've been saying all along in this series, we want to try to stay in or hold the trade until that bullish evidence is no longer there. There's 2 ways to do this based on, again, that keyword of market context. Okay, so the first way, well, let me backtrack a little bit. So let me talk about that word context a little bit more. We're using context to determine what I call the burden of proof. You hear about the word burden of proof when you're watching a Law and Order or whatever, it's a legal term. And so the context determines the burden of proof. So again, assume we're long in this example, we've bought, and let's assume our market context is neutral or bearish, so not really good. If you still want to get into the trade, the burden of proof is on the market to prove that you should stay in. Okay? So in other words, we got in, it's a little bit more of a risky trade. At the first sign, we have a quick trigger to get out of this trade because it's not a great opportunity. The market has to prove to us. The burden is on the market to prove that we should stay in. Okay? This is really a key point, so I hope this makes sense. Now, let's say, on the other hand, we get long, and the market context is bullish or extremely bullish. In this case, we have a great opportunity. We want to give the market every opportunity to give us as much profit as possible. So in this sense, the burden is on the market to prove we should get out. Okay, so on the first one, if it doesn't work quickly, we get out of the trade. If it's not proving that we should stay in or there's any sign of trouble, we get out. In the second one, we want to stay in. We're saying no matter what, we're staying in until this market just absolutely proves to us we should get out. I hope that makes sense. If not, let me know. So here is an example. Okay, again, let's say we get long. Same example here at 78. Okay, and in this case, the market context is neutral or worse. Okay, so in other words, we want to get out. We want the market to prove that we need to stay in, and it moved in our favor pretty quickly. So okay, we're good. So then now, what are we going to do? The first sign of trouble, we want to get out because, again, we're swimming upstream. Our first priority is risk management. It's protection. Now, I grant you, sometimes you will miss a big trade, but overall, your expected value is much higher because you're using the market's context to help you judge how aggressive you should be, to get out of a trade. So again, let's assume we're long and the market context is neutral or worse. It needs to prove it moves in our favor quickly. Okay, good. So now we have a buying aggression bar. Well, let's see. As long as that doesn't fail, we're good to go. Let's put our stop a couple ticks below that. Okay, great. We continue higher. Then we get another buying aggression bar. Well, let's put our stop a couple ticks below that. Well, okay, we're out. Okay, the first sign of trouble, we're out of the trade. Because, again, we're not expecting a ton out of this trade because the market context was neutral or worse. Okay? Now, on the flip side, let's say that in this situation, same entry here at 78, let's say in this situation our market context is bullish or extremely bullish. In this case, we want to give this trade every bit of room. The only way, in other words, think about it, the only way we're getting out is that the sellers just tell us we have to get out. The sellers have proven us. So we're going to hold this trade as long as possible, make the sellers prove themselves. In this, using aggression bars, we're only going to exit when a selling level 2 or level 3 bar has some follow through, okay? Now this is, again, we're swimming with the current. So our first priority is profit maximization. And I will grant you, sometimes you're going to miss out on taking a small profit in the hopes of making a bigger one. But overall, using context, your expected value is much higher. So again, we're long here. We have a buying bar. Great. No selling. No selling. We're just going to hang out. Or more extreme. Here's extreme buying. This thing goes sideways. You could tuck yourself out of a lot there. No selling. Oh, we get another run higher with this extreme buying. It's not until here that we actually have some selling. So we're able to hold that. So instead of a 2-point gain, 3-point gain, 4-point gain, we can get in the order of an 8-point gain. Okay, it's not really relevant how big this particular trade was. It's the idea of using context to help you determine the burden of proof. Again, the idea of, do I make the market prove I should stay in, or do I make the market prove I should get out? Okay, I hope this makes sense, because if you can grasp this concept, it's so powerful for your trading. So I hope that makes sense. And again, I've used examples of the relative aggression bars because I think that's showing you under the surface exactly when buying or selling is coming in or failing or whatever the case may be. I think it's very helpful. I would highly recommend that you use it as well. But you could use whatever strategy, whatever evidence you're using, apply it. Use it in this way. And you'll find that it's very, very helpful. So hopefully these 3 strategies were helpful. You could grab a nugget out of here that you could apply to your trading. And I think, and I hope it will certainly help you. In the next video, I'm going to do a quick one on kind of a counterintuitive loss reduction strategy. So hang around for that one, and I hope that you find some benefit from that as well. All right, let us know if you have any questions, and we will talk soon.